So let's talk about debt and equity just a little bit. And debt and equity, everybody has debt, and we know about debt, and we're sometimes comfortable with it and we're not. But the news said that credit card debt and student loan debt and mortgage debt is so high, higher than it's ever been. And we know about credit card debt and student loan debt. And that affects property ownership because there's just less equity to buy everything that we want. And we're a society today where we want it now, and we'll just go get a mortgage. We can make the payments, and lenders know this, and that's good because we couldn't do it without debt. And so debt is good in a lot of times, but debt can be very burdensome at times also if it's used unwisely, or if the economy shifts. You get a big shift in the economy and debt can really be a burden. So there are ways that we can minimize that, and that's equity marketing, and that's talking about debt and equity and doing those things that are outside of the box, which is trades and exchanging and using equity in other assets. We don't ever think about that. When you go to buy a house, you don't think about, oh, I've got equity here I can use, or can I use this equity? We just go to the lender, apply for a loan, and either we get it or we don't get it. And sometimes, depending on the risk, the lender can really make the deal difficult. And there's other ways to not use the lender, because lenders today are really burdened with a lot of rules and regulations and things that have come along to help protect the public. But there are hard money lenders and private lenders, and there's trades and swaps. And so there's all kinds of ways that we can look at to minimize debt. And when I have a customer or client come into my office, that's one of the things we definitely talk about. We talk about debt and equity and what other assets do they have. You know, over the years, I've found out that if you just ask the client what kind of assets they own, you'd be surprised at the things that people own. I mean, houses and land and cars and motorhomes and property that they will never use, and notes and deeds of trust and stocks and bonds, and you can just go on and on and on. But the big business today is renting money, and that's what the lender does. They rent that money, and they rent it out for anywhere from 3 to 4 to 5 to 10%. Hard money loans probably be in the 8 to 12 or 15% loan range, and that's not bad when you sit down and figure it out if it's short-term money. And if it's for commercial or investment purposes. And a whole different ballgame if you're going to talk about owner-occupied residential lending. And that requires the use of an attorney or a mortgage loan officer to help you through that process. But private money lenders, hard money lenders, and other ways of doing business is not burdened by the same things that the banks are burdened by. And so renting money. Have you ever thought about savings and loans and insurance companies and private companies, private individuals? Some people have inherited a lot of money or have an insurance policy pay off. And those are funds that they could invest it in a stock or a bond or something like that, or a CD at a bank and get nearly nothing. Or they can loan that money out at a rate of anywhere that they're comfortable with, 6 to 8 to 10%. And they can do it long-term or short-term. So private companies, private individuals, hard money lenders are all really good sources of funds. But be aware of this, that the debt is always there, and it's hard to get around the debt. Unless you're just very lucky and things go your way, it's very hard to get around the debt. So this is a friend of mine that wrote this book, Bob Steele, And this is 300 ways to buy, sell, and trade real estate or exchange real estate. Very good book. I mean, there's a lot of formulas in this book, and we call them formulas because here's a formula. Cash and land equals purchase price. Cash and note and land can equal the purchase price or the down payment. So there's just 300 ways or more that these fellows over the years have put together and are able to do transactions in real estate. And so that's how you reduce your debt from the lender, is you use other assets. Let's say that you've got a lot that's sitting over there and you were going to build a house on it and you're never going to build a house on it. So you try to sell a lot and the lot hasn't sold. So you've got, say, 50,000 equity sitting there in that lot and you want to buy a $300,000 house. Why not offer the seller of the house $50,000 and you say you've got $100,000 for a down payment, that's $150,000. And so you go to the bank or the lender and you apply for a $150,000 mortgage. Several good things happen right there. Your mortgage is going to be less. Your payments are going to be less. And so that's good. And you've used that lot, that vacant lot that you would have never built on, and that's equity. And now that new owner of that lot can do the very same thing that you did. They can sell it, they can trade it, they can use it as a down payment, or they can do something else with it. So that's a really good way, I think, to do business. And so we're always asking the client, what else do you have that we can use? Now, here you can see this fella, he is carrying that debt. And when you talk about real estate, you've got debt, and that debt, it can be a ball and chain just like that is. Let's say the lender has loaned you that money, and the lender is not going to be in trouble that much, because if you look at the chart, when you look at the chart, you'll see that the lender has about 80 or 90 or 97% loan to value, which means you got 3% or whatever you put down on the property. So everything above you is the lender. The lender is your major partner in this deal. And you've got other partners, which is the tax assessor and the insurance person. And if you didn't put down more than 20%, then you have mortgage insurance and they've got a vested interest. So you got all these partners in here. And so if you could minimize that debt, that would be great. So if you minimize the debt using other assets, you increase your equity. And it's all about equity and what you can do with it. And let's look at it this way. That lender has loaned you the money so he can make a yield on on the money. And that yield is anywhere from 6 to 6.5% on some properties. And I'm not saying it's the yield on your property, but the yield is the rate that the lender is going to get for loaning that money. And it's big business. And there's hardly any risk because they have mortgage insurance and they have other ways to protect their assets. Now, on a commercial piece of property, if your loan to value or your debt coverage ratio goes down, let's say the market goes down, and then your equity has gone down. And so when your equity goes down and the loan to value ratio gets where it's putting the bank or the lender at risk, on a commercial property, they may ask you to bring some funds in to push their loan to value ratios back up into an acceptable range. So there's a whole lot of difference between commercial property and residential property. I've never seen that happen with residential property. But look at it this way in the chart on the screen, the investor takes all the risk, whether you're a homeowner or whether you're investing in commercial property. If you're refinancing, you pay the title insurance, you pay the taxes, the insurance, the appraisals, the recording fees, you pay all of that. And the bank or the lender does not pay that. In fact, you'll also pay for mortgage insurance premium. And you will pay for mortgage insurance through the title company. But we all expect that, and we know how that works. So there's very little risk, and I put this on the screen. Value less debt equals your equity. And if you got 3% in the property or less, then you have very little equity. But if you used that $50,000 lot, then you might have more. You might have 10% equity in that property. So that's how you increase your equity, and you bring things up. You reduce the debt requirement, and you use other assets to increase your equity. So very good. And that's a formula, and that's in the book. Now, here's a fella. He says that I can't get the loan because I have no cash, but I've got a piece of vacant land. Vacant land, motorhomes, houses, buildings, promissory notes, created notes, and that gets to be in a little bit higher realm. So here's cash plus a motorhome equal the down payment on a house. I mean, you can do those kind of things. And that's why I asked the client, use other assets, cash, promissory notes, created notes, land, crop futures, leases, personal property. All this has equity. And you know, the thing about it is that we as brokers are people, even you don't have to be a broker, but we just fail to ask the seller what they would like to do. You never know, that seller may want to sell that place really bad and they need to move on with life. And so they would look at your equity in a vacant lot very seriously, especially if you got a $300,000 house or anything like that. You have to make it attractive, and he can get $250,000 cash in a vacant lot. That's pretty attractive. And so that's how equity marketing works in the very small way, is that what you have, somebody will take, and you want to use that equity to minimize your debt need. And we all need debt, but we try to minimize that. So let's put this fella back up on the screen. He's carrying that debt around. We'd like to not carry that debt around. It would be nice to be able to get rid of it. Here's an opportunity. This building is in Florence, Colorado, and it's $1 million. It's got 3 floors, 17 apartments that are being remodeled, and the downstairs has a restaurant and a couple other retail spaces. And this owner, and we've counseled him, and he is also very knowledgeable himself, and he will take cash and land and houses and motorhomes and promissory notes for his equity in this building. And so if you're looking for commercial property, that's a building that could be of interest, especially if you've got other equities that you would like to see if somebody would take. 40 acres of land next to BLM. It's free and clear. There's no debt on it. Now, what could you do if you had a $40,000 piece of property? Would you take and trade that for something else as a down payment to go up to $500,000? Would you create a promissory note against it for $100,000, which would leave $65,000 in equity, and take that $100,000 note and trade that for something else? I mean, that's how you do this. You create a note. People don't want the land, maybe, but they would certainly take a promissory note that had monthly payments at a good interest rate. So think about this. If you would like to have 40 acres next to BLM, beautiful piece of property, and you've got an asset that you would like to have me look at or trade for another asset, then give me a call, and my information is right here on the screen. The form of equity. A friend of mine said once that cash is a commodity. You can't eat it. You could sleep on it. You can carry it around in your pocket, the cash, but that's about all you can do with it, or you can trade it for other assets or property or personal. You can use it. It's liquid. It's easy to get rid of. It's easy to move around, and everybody takes it. And that's number one. But other assets are just in a different form. Personal residence, building, promissory notes, land, ranches, and many, many more. If you look at it, ranch is like, well, this is equity. I've got this much equity in that. And I've also got debt, and we handle the debt because the lender wants to be paid back. But I've got all this equity. Why can't I use that equity to buy something else? I mean, the cash you have in your pocket is equity. The land you have is equity, it's just in a different form. So when you think about it like that, you try to figure out ways that people will take your property. Thanks for watching, and I will end the broadcast.